All right, guys. Thank you for making the time to be here today. This is the April 2025 State of the Market Economic Update call for the Sarasota and Inglewood locations. And of course, we do this call every month to be able to equip you to be able to talk to your clients, to be better educated about what's going on in the economy and really how that trickles down and impacts both the housing market and your own agent business. And I spend about the first 30 to 45 minutes of my day every day just kind of knee deep in economic data. And the genesis of this call, of course, kind of came from when I would speak at a team meeting or we would have some conversations. Agents would say, "Boy, we'd love to have more of that." And so that just turned into this monthly call. So I appreciate you being here today. We've got a lot to cover and there's been a lot happening. So let me just share my screen. Let's see here. There we go. We will dive in. Miss Kennedy is monitoring the chat. So Kennedy, if you have someone that has a question or needs any help or assistance with anything, let me know. And I'm going to move you guys over here so I can see y'all. Okay. So you all know who I am. Operating principal for KW Coastal Living 1 and 2. And there's my contact information if you're a guest and you just need to reach out and get more information on anything. So to start off, we've got a lot to cover today. I want to just do a catch up on what's happened since our last call. And I keep a running tally through the month of the things that happened in this month. My list was probably about 4 times longer than usual. So it's been a very, very active month in a lot of ways. So let's talk about what some of the primary drivers of what's happening in the market is right now. The first thing is the tariff tap dance has turned into more of the tariff dirty dance here. It's hit high gear and is really kind of working its way through the economy. Of course, Trump enacted tariffs in his first term and got into a little bit of a tariff tap dance then to better position the U.S. Trade deficit. The difference is the last time interest rates were low, inflation was low. We were at a spot where the impact of tariffs couldn't really, it could be absorbed by the economy. This time, knowing that he had a shorter window to be able to work with, he got a little bit aggressive here in the first 100 days. And of course, you guys have heard a lot of data on that, and we're going to look at the impact of what that's had on the housing market today. Now, suffice it to say, anything I say on these calls, please remember it's apolitical. I'm not endorsing or condoning, or I try to keep it just to the facts. So anything is, it's neutral. Those tariffs have led to some extreme stock market volatility. And if you've looked at your retirement accounts the last couple of weeks, it has been a roller coaster. That has pushed the 10-year treasury into a roller coaster also, which trickled down into interest rates. And unfortunately, last call in March, interest rate spreads were actually getting better. There were some things that were starting to improve, and we've taken that mostly off the table, but there's still some good news. We also had some negative Fed announcements, and of course, if you've watched the news at all, you'll see that Trump and Jerome Powell have been in an absolute dust up. And it's ironic because Trump actually put Powell into place. He put him into place in his first term, nominated him, and they definitely do not see eye to eye. So that is having some ripples through the economy. The good news is inflation has been cooling. Let Wayne in here. Oh, hey, let's go back. Inflation has been cooling. Unemployment, on the other hand, is rising, but we're still in a pretty good era. We have some policy that some of Trump's nominees are starting to roll out that will have some impact on housing. And let me move this so I can see that. And one that we've not talked about in a while is builder confidence. There's some changes happening in builder confidence around the tariffs that are really starting to kind of give some indication of what's happening inside the new construction world. So let's break this down a little bit and look at what this looks like. So as it relates to the tariff tap dance that's gone into high gear, this has really had a a pretty wide-ranging impact on the financial markets overall. And for the most part, this is all because of uncertainty and just the not being sure of what's actually going to happen or where things are going to go. Now, Trump, of course, it's interesting. We were on a call with John Maxwell about 2 months ago, and someone on the call asked, and I thought this was really interesting, and I think it applies to this. Someone asked, how would you define Donald Trump as a leader? And John Maxwell, being the leadership guru, answered in a way that I did not expect. He said, he's not a leader, he's a negotiator. He's a businessman that negotiates. And when he said that, I kind of paused for a moment because I thought, well, that puts some of this into perspective. I think all too often, sometimes leaders have a hard time like doing the tough stuff, and in this case, his negotiator style of leadership has kicked in, and he's gone all in. Now, that's created a lot of uncertainty in the market, and uncertainty around inflation, uncertainty around the equity markets, uncertainty of what that could do in terms of potentially pushing us into a recession. When you think about it, the last recession that we were in was 15 years ago. And from an economic cycle perspective, that's about twice the time it usually takes to go in and out of a recession. So we've had a good run. The challenge with the tariffs as it relates to housing is that builders have indicated that new construction costs are expected to be up about $10,900 on average currently. And I'm going to share a little bit of the information from the builder sentiment survey on this call so that you can see where that's coming from. So here's what's happened. This is the last 30 days of the stock markets. Of course, April 2nd was dubbed Liberation Day, and we initially had a little bit of a surge, and then of course we kind of went off a cliff with the the stock market, the Dow 500. As we've gone through the month, it's been a roller coaster. At one point, there was some indication that the president was interested in firing Jerome Powell. And I think about this in terms of kind of like basketball, the kind of rough a little bit. I think some of that was positioning and posturing. However, in this case, that conversation really spooked the markets, because if that would happen, it would mean that any incoming president could simply hire and fire the Fed at will. And that kind of separates, or that takes the separation between the economic policy and the legal or the executive policy. There's currently a little bit of a Chinese wall there. So that sent the markets down and back up. And of course, this week, Trump did announce that the tariffs on China would be short-lived, and he indicated that he was willing to bring them down to, I believe it was 50%, or bring them down by 50% to bring China to the table. And that gave the markets a little bit of calm. And I think in that commentary, he also indicated that, like, hey guys, this is not going to be a long-lived thing. We're working on it, and indicated that within a couple of weeks, we'd have some clarity on a lot of things. So this has been the impact. The 10-year Treasury, which is what drives your 30-year interest rate, has went down to as low as 3.86 and as high as 4.56. In one 30-day cycle, this is a massive swing. Like, we just don't typically see that kind of a swing. 3.8 is called a key technical level. When you hit 3.8, 4.2 and 3.8 are kind of two markers that, in order to go below 3.8, we would have to have a lot of worsening jobs data. We'd have to have unemployment rising. We'd have to have the economy slowing substantially. But we pushed right against the low. The investors are still weighing the impact of what's happening. And one of the challenges that we're seeing, and we saw this the first go around also, is that business investment is slowing dramatically. Businesses are afraid to make investments. They just don't know what's going to happen. You don't want to open a new plant and have a recession creep up on you. So we're watching that closely, because business investment slowing could kind of grind the economy to a little bit of a halt. Um, and of course, in this all, China is playing hardball with the U.S. But I think it's important to know their economy is very weak, and they're not in a great position. So the negotiating power of the U.S. to close the trade deficit is probably we've got more of an appetite to deal with it than China does. So that's probably the good news. When we look at how this looks on the 10-year Treasury market, you can see April 2nd again, much like the stock market, we were kind of at a little bit of a higher point for the month, and then we swung all the way down. You can see the swing down and then back up and down. So today we were actually on the way back down again. But the challenge is that the spreads between the 10-year Treasury and the 30-year have not been good. So if we just look at really where we were, April 17th, we hit 6.83%. And this week we hit 6.9. It's the highest level in 2 consecutive months it's the highest level in 2 months after declining 4 consecutive weeks. We have a concept that's called lower for longer, and that lower for longer is what typically will spur mortgage purchase application and mortgage purchase demand. So we're still below the 7% that really starts to slow buyers down substantially. And we've been there for 13 consecutive weeks. So as it relates to this year, we're actually looking a little bit better overall in terms of what's coming into the market. Unfortunately, when you look at the annualized U.S. sales pace, we're still on track at an annualized level in March, about 4.1 million home sales, which again would still be on par with the lowest sales pace in U.S. history. So that's the challenge that you're feeling in the market. There's some good news in this. April 2024 rates a year ago were at 7.1%, but purchase application demand was 13% lower than it is today. So if you look at last year versus this year, mortgage purchase application is actually on the uptick. It's a sign that this year's spring homebuyer season's off to a stronger start. So that's good news. But the challenge is we're not likely to see rates go a whole lot lower until the labor data breaks. But what can happen is those spreads can improve. And this is where I talked about lower for longer. Historically, when we see the interest rates drop down, typically by about a half point or more, and they stay there in that 6 to 8 week cycle, that's when we see buyers really coming off the bench and committing to new mortgage applications. But the good news is we're still at the lowest level of mortgage rates since December of 2024. So we're still headed in the right direction, even though things go up and down. If we look at the last month, you can kind of see, actually, I think this is 2 months, February to April, February, March, April. This might be 3 months. You can see we were sitting at about 6.9%. Back in February, we hit a low of 6.63%, which I watch these daily, I'm going, this looks good. And here we are back up at 6.9 today. Now, again, I try to cover this in every call so you understand when the news announces that there's been a rate cut by the Fed. I know that our clients all call and say, did rates get better? Well, Fed policy is only about 35 to 40% of the impact on interest rates. The other 60 to 65% is actually what happens in the 10-year Treasury. Typically, the 10-year Treasury, the difference between 10-year and a 30-year fixed rate runs 1.5% to 2%, somewhere in that ballpark. And we call that the spread. How much of a difference or how much of a margin is there between the underlying rate that affects the actual 30-year mortgage rate. The challenge historically, or that we went through in 2023, is June of 23, we actually hit mortgage spreads that were as high as 3%. And this is in the history of mortgage, extraordinarily high spreads. And again, that was a lot of the uncertainty of what was happening. We had the Silicon Valley Bank crisis happening and just a lot of things that created uncertainty. That's when we saw nearly 8% rates. Now, when I did the math yesterday, 10-year Treasury yesterday was at 4.4, 30-year fixed rates were at 6.9. So we're sitting at a 2.5% spread. This is still pretty high relative to where we want to be. And what can happen is if we can see either one of two things, either some softer economic data, particularly the labor market starting to break. And that means the labor market starting to, the unemployment rate starting to increase, or we just get some confidence and some certainty back. And that very likely could be as the tariff tap dance subsides, that could bring those spreads back into a more traditional level. And that would cause us to be, even at today's elevated rates, or I'm sorry, elevated 30-year Treasury levels, 10-year Treasury levels, thank you, that could bring us down to a 6 and 3/8 rate without any Fed policy changes at all. So at those levels, we do typically see mortgage application demand picking up. And if they stay there longer, that longer for lower, we do see the resale market picking up. So fingers crossed. I feel like this is the watched pot that just won't boil. Last fall, we felt like we were in a good position and we were going to see rates really drop and stay there. And of course, they shot right back up. So enter the Federal Reserve and Jerome Powell. I said the 30-year Treasury or the 30-year interest rate and the Fed's fund rate is correlation, not causation. So when Jerome Powell talked this month, he said the Fed is in no hurry to lower interest rates. He said he's preferring to wait for more data on the economy's direction. Now, Trump called him out on this and called him old and slow. And traditionally, to be candid, the Fed does typically get a little behind the eight ball. They're not usually aggressive in cutting early. It's usually a little later, and that leads to a soft landing, but sometimes it actually draws the economy down just a little bit. Now, Jerome Powell did express concerns that the tariffs could lead to a rise in inflation and an overall slowing of economic growth. But he did say, despite heightened uncertainty and downside risk, the U.S. economy is still in a solid position. And this is our challenge in the housing market. The housing market's really been in a recession for now 4 calendar years, and yet most of the rest of the economy, and particularly financial services and industries that typically are related to housing and kind of trend with housing, they're in a boom. The economy is doing well. We're technically at full employment at 4.1%. The economy is just doing well. And as a result, the Fed is unwilling to make cuts. In fact, he acknowledged a two-sided risk of monetary policy, noting that easing too soon could fuel inflation, while easing too late could harm employment. But at the last Fed policy meeting, they made it really clear that it was labor over inflation. In other words, inflation's in check, but it's the labor market that they're watching. So even if inflation were to go down to 1%, if we did not see the labor market breaking, they may not be likely to make much of a change. Now, he emphasized the Fed can be patient and wait to see how the tariffs and other policies play out before making any changes to interest rates. And I think that was a little bit of a middle finger to Trump on this. So we remain in a hawkish or restrictive position. As it relates to inflation, our month over month inflation rate was at 2.4%. It's the lowest since September of last year. It's down from 2.8%. And it beat forecasts of 2.6. So inflation is coming into play. Much of the decrease in inflation is the cost of crude oil. Crude at the height of our 9% inflation was running $115, $120 a barrel. If you look today, I think we're at like $62 a barrel. That's starting to be reflected at the gas pumps, although not as fast as I expected. So you do have energy costs, and some of those things are coming down. Food costs, unfortunately, are still up. So that's still a big component of that inflation. This is what this looks like on a month over month basis, just to get a perspective of how we're doing. And you can see March came in at 2.4, kind of a downward trend all year. And yet, if we look back, and I highlighted May of 2022, but it was actually June of 2022 when we hit the 9.1% inflation rate. So you can see we've remained steady. We've gotten back to a better position, but we're still a little hot. And depending on what happens with the tariffs, that might push that number up a little bit. I talked a little bit about unemployment. We rose 4.2% in March, highest level since November of 2024. The Fed was still projecting, set a projection of 4.4% this year. It's interesting. I think they hedged a little bit on this because I feel like they left that number a little low, knowing that it gave them some room to pivot faster if they needed to. So I think that was an interesting projection on their part. So if we look at it from this perspective, you can see how the month-over-month data relates, and we're still sitting pretty good month over month, 4.2. 4% is considered full employment. Everyone has a job that should have a job. We look at this historically, though, you start to get a sense of how low unemployment got through that 2022, 2023 level, and you can start to see that upward trend. And of course, this could be the labor market, starting to trend in the direction of breaking. In this data, some of the interesting subcategories is construction labor, and we're at a time where much of the 5-unit and above new construction, which is usually multifamily housing, those projects are starting to come to an end. And with higher interest rates, builders are a little less likely to start new projects with the cost of money, which means we have a lot of construction workers coming to the end of their employment cycle. And the multifamily housing construction is always the canary in the coal mine that typically leads us into a recession. So watching what happens with new construction starts over 5 units and above, that's something that the Fed's watching really closely. Now, this is one we haven't talked about before, so I brought this in. The Home Builders Sentiment Survey, there was a little bit of mixed data, but the home builders every month rate their confidence or their sentiment on a scale of 0 to 100. It's actually 1 to 100. We're sitting at 39.40 right now. They cited economic uncertainty from tariffs and elevated building materials as their two biggest concerns. And it's interesting that even though we were headed into the tariffs, the number bumped up 1 percentage point, and we think that was due to just a little bit better mortgage rates and an uptick in mortgage purchase applications. The challenge, though, is that when they ask about the impact of tariffs on their business, 60% of builders said that their suppliers have already increased or have announced increases in material prices. Now, 60%, it's still pretty early. That's a big percentage. And the average increase was 6.3%. And of course, I said earlier that correlates to about an $11,000 increase per home. Now, I always jokingly say the builders are not the march of dimes. They build homes for a profit. And so they're able to control the supply of inventory out there. And when sales slow, they'll slow down their building. They do that to keep their margins in place. And that's something that we don't have control over in the single family resale market, residential resale market. So what happens when those margins compress, builders are less able to buy, the interest rates down, which is what has been keeping the new construction market extraordinarily hot. And when you look at the difference of the new construction market and the residential resale, it's a tale of two markets. Those low interest rates have attracted a lot of buyers. So we may see some of that starting to slow down. And in fact, these were two interesting statistics I pulled out of that report. 29% of home buyers cut their prices in April, and the same percentage had cut in March. So a third of all home builders are actually reducing their prices. The average reduction was 5% in April and 5% in March. And builders indicated that 61% of all transactions had sales incentives on them. Those are going to be rate buy downs, special mortgage financing, included upgrades, up from 59%. The builders are willing to give away a little bit more to keep activity moving. Now, if we look at this index, you can see April of 2022, just before everything really started to turn, the builder's confidence was at 77, and you can see where we're sitting today at 40. So that's an interesting development and something that we'll watch real closely in the months ahead. Some of the other housing policy changes that have happened. Scott Turner was confirmed as the Secretary of Housing. Scott, part of his history is he created opportunity zones, which if you are familiar with OZs, it allows you to put money into a kind of a distressed area. And after 10 years, all capital gains of that investment are wiped out. And so it's an incentive to go into neighborhoods that you might not otherwise invest in. And there's been a tremendous amount of money moving into those areas. So this would help to build affordable housing in those areas, and could be an interesting development because we need somewhere in the neighborhood of about 3 to 3.5 million homes just to kind of get to a healthy level. And there's just no way we can build things that fast. Trump also took a chainsaw to the CFPB. I am going to say personally, I don't know that this is a bad thing. I've personally seen the CFPB go after people in situations and cost hundreds of thousands of dollars, only to after the fact go, whoops, nope, you didn't do anything wrong. So they're a very aggressive agency, and yet they are in charge of overseeing every transaction that involves any kind of consumer finance. So anything from payday loans all the way up to the mortgage markets. So it was a 90% reduction from 1,680 to 200 employees, and some departments actually only have one employee. The CFPB labor union challenged it in court, and a judge upheld that. So it remains to be seen what's going to happen with this. But here's the interesting part of this. The incoming appointee actually has a history of being very pro-consumer when it comes to regulation. And it's a little bit of an irony that you wouldn't expect this person to be taking over that department and have them be cutting so far back. But the one forward guidance that we did get was they did indicate that they're going to be aggressively pursuing mortgage fraud, and they're going to have more of a focus on the mortgage industry. The unintended consequence of this, though, is that right now, the CFPB sort of regulates by action. In other words, they don't give you the clear guidance of here's how you operate, but they'll come in and slap your finger or slap your hand and fine you very heavily if you mess up. The challenge is, at least right now, we have one regulatory agency that we are kind of paying attention to. The unintended consequence of this could be that the states start to pick up more regulatory activity, in which case you may have 50 or 51 different entities that now you're beholden to on a national level as opposed to just one. So it's going to be interesting to see how this plays out. I have a feeling that ultimately the CFPB will be cut back substantially. I think Trump will probably win this one in the courts. Now, of course, I left this in here. This is from last time. If you weren't on and you haven't seen this before, when your customers talk about just what's happening in the market, this is the statistic to really remember. When we look back at the last 5 years, the challenge that we have overall in the market is just an affordability issue. And I get the question all the time of, is this 2008? Should we be worried our price is going to drop like a rock? And the answer is no. Based on the data we see today, that is not the case. 2008 was a job loss recession, and it was also a period of time that, I remember selling, and we were doing 80 10 10s, 80 20s, 103, 106% loan to value transactions. And of course, a lot of homeowners just got underwater very quickly in that type of a position. Today, the U.S. balance sheet of the residential homeowner with a mortgage, or, well, I shouldn't say that, the residential homeowner today that has a balance sheet that's better than it's ever been in history, meaning we have more equity, and currently 38% of homes are owned free and clear of a mortgage. So we're in a good position. We can weather a little bit of price adjustments without it turning into a housing crisis. If we look at this, these are the two numbers. It's 5 years, appreciation in the US has been 41%, and wage growth has only been 14%. So you can do the math. One has got up a lot more than the other. By the high interest rates. And when we look at this is from National Association of Realtors. In 2021, the average principal and interest payment of a medium priced house was $1,206. At the end of 2024, actually, this was Q3 of 2024, it was $2,100, meaning the amount of money a borrower needs to be able to, as they did in 2021, is a 46% increase. The math is just challenging. And this is where we've had really 3 calendar years where we've had anywhere from about 1.1 to 1.7 million transactions that historically should have happened. These are births and divorces and graduated students that are moving into their first careers. That those are really, I'm not a big fan of the sideline home buyer or seller, but those are transactions that are sitting there that at some point that hose is going to unkink and those transactions are going to come out. But it's going to take the affordability getting down. It's going to take getting interest rates back into those low 6s to spur demand. So just, this is a good one to keep for your sellers. It's a good one for buyers to explain what's happening, but it's a good one to explain to sellers that this is impacting buyer sentiment. Okay. So let's look a little bit of national housing market nationally. And again, it's a little bit of a tale of two markets when you look at the national numbers versus the Florida market, although there's still some very positive things happening. Nationally, we're still in a seller's market. Median list price 450, and I believe I've got this here from last month. The median list price has increased. The median price of a new listing has also increased. The days on the market has gone down, and that's an indication of those January new listings that have happened versus kind of some of the stuff that was stale on the market last year. Median days on the market 56. Price decreases 36%, and of course historically 34% of properties will take price reductions at any given time. So it's pretty healthy in terms of the price reductions. Inventory, we're pushing up in inventory, and I'll explain to you kind of what that trend looks like here in a future slide. But right now we're up about 9.7% month over month, and that's an indication that we have that spring selling market that's really starting to roll out. We look at condos, it's a little different story. We're still in a seller's advantage with the condo market nationally, and yet when we look at this, the median list price increases are they're creeping up a little more slowly. They're still up. Days on the market nationally, 63 days. So they're still moving pretty fast. And inventory is up also, I believe that number 9.6, that is accurate. So we're same amount in the condo market. So now when I show you what's happening in Florida relative to the US, this is where things get a little bit interesting. So looking through this, here's your housing supply. We hit 240,000 resale units, and this data comes from Altos, by the way, but we hit 240,500 in March of 2022. We call that the savagely unhealthy market. This is too many buyers chasing too few homes, and that's where we saw these massive increases in prices in the 20, 30, 40 offer situations that we have. The good news in what's happened, and if you're a newer agent, it doesn't feel like good news. I acknowledge that. But the good news in what's happened is the market inventory has started to allow us to get back on pace for a healthy level. When you look at home buyers, 82% of all home buyers bring a listing to the market. So that means that when things start to heat up this time, our inventory is actually likely to continue to rise, even though the sales pace is going to pick up. That's something we haven't seen in a few years, and this is actually really good news because this sets us up for a really, really good 5, 6, 7, 8 year cycle on the other side of this interest rate challenge that we're facing. So that's the good news. Average days in the market's currently 106. Up from that low of 54 in July of 2022. And it's funny how many of these, the lows are going to be June or July of 22. Properties with price decreases, of course, 34% up from the March 2022 low of 16.6. Homes coming back on the market. This is an interesting one. I was a little surprised to see this, but it's only about 9.7%. So I'm not sure if that's an indication that we just had some sellers from the fall and the winter months that just have not re-entered the market yet. They're watching. I don't know if that's the impact of tariffs. Not really sure, but that number is a little lower than where I would expect it to be this time of the year. But if we break that down into market segments, and let me move this off my screen here for a second. There we go. There we go. Now I can see. If we break this down into market segments, you see the red line is the bottom 25% of the US market. The yellow is the second tier, 25%, then the third and the fourth. You can really see the volatility in the upper end of the marketplace and what's happened both seasonally and through some of the rate cycles that we've seen. So currently the top tier median is 1.1 million, goes down to 539, 360, and 215. And if you look at this real closely, it's kind of hard to see, but you can tell that median list price of that bottom 25%, it still continues to go up. You just are seeing a little bit of softness in this second and third tier of the market. I'll show the Florida numbers and how that looks also. So let's dive into Florida. Currently, for the state of Florida, we're sitting at 32 for the market action index, which means a slight seller's advantage, still generally a seller's market. One thing I did not point out in this, I want to say is all of this data does come from Altos, and Altos tracks every listing for sale in the United States every single day. So where NAR's data is typically anywhere from about 45 days to about 3 months old, this is all literally up to the moment today. But Altos only tracks, and someone asked me this last time, Altos only tracks homes that can actually be purchased in the next 30 to 45 days. Meaning if it's a new construction, start that's out, 180 or 240 days, they actually strip that out so that we really know what is the actual inventory that someone can go buy and move into somewhere in the relative future. So that's where you're going to see some of the data differ just a little bit from the MLS. And that was the question I got last time. 500,000 median list price. We look through this, median list price is up. Average days on the market staying pretty consistent, but down a day. Florida price decreases are substantially higher, and inventory is rising at 105,699. And let's break down the condo market, and then we'll go into some specifics. Condo market in Florida, we are definitely in buyer's advantage territory right now. It's a buyer's market. You can see up in the right-hand corner that median list price has dropped and has stayed pretty consistent around 350. You've got 98 days median days on the market, so quite a bit higher than residential, both in Florida and nationally, and price decreases 41%. This is month over month, so you can see pretty consistent month over month, but price decreases, price cuts have continued to rise. But here's the story that I think really stands out at a big level. The Florida single family, so if we take all of the single family available housing stock and we add that together with the condo inventory, there's currently 181,000 properties that are available to be sold. The United States, when we add that same number together, total, it's 919,000. Wow. Currently, Florida has 20.2% of the 19.5% of the total inventory, and 20.2 was last month. So we're getting a little better because there's more inventory coming on, but that's 1 out of 5 homes for sale in the entire US is in Florida. And I know I have not looked at the number this month, but Texas is not far behind us and may actually now be ahead of us. And it's part of the reason why housing in Texas is starting to see a pretty significant cut in prices, and you're actually seeing some price declines in the average sales price. So when we look at just the condo market, this is a whole different picture. And of course, we know Florida has a lot of condos. We are the Sunshine State and in a snowbird destination. But with 72,000 condos for sale and 219 in the US, it means we've got almost a third of all condos for sale in the entire United States, all 50 states, just in one state. And that's a challenge, especially when you compound that with the rising cost of Homeowners association dues, I know mine have gone in the last couple of years from about 700 to over 1,800 a month. And my insurance has gone up about 2.5 times, which is pretty much in line with what a lot of people have experienced. So just, it's an affordability issue again across the board. Now let's break this down into the local housing markets. I'm going to go through the 3 counties and I'm going to give you some analysis and some data that you can be able to take back. I'm going to start with Charlotte County. So we are now in Charlotte County in a buyer's market. And if we look at this, Charlotte County median list price 425, median price of a new listing 434, 139 days on the market. So you can see that days on the market is really getting up there, and price decreases are sitting at 56% of the market. So more than 1 out of 2 have experienced a price decrease over the course of the listing. Now, I've got some data for you on what's happening with those price reductions and how it affects market time. And I'm going to tell you, it was staggering, and it really emphasizes the importance of getting the price right the first time. So if we look at the condo market down in Charlotte County, median list price 277, 54% price decreases, and interestingly, median days on the market's 91. And that's quite a bit less than, let's see, average days on the market was 147 and 139. Sorry, I didn't mean to give you guys whiplash. So it is taking a little bit longer for the condos to sell, which is typically what we expect to see. 4% of those condos have been relisted. So if we break this down into the Charlotte County availability of housing stock, we're sitting at 3,744 homes, up from the low in June 21 of 282. I mean, it's just a staggering number when you look at that. Again, a return to a more healthy market. This is not a bad thing. This is actually a good thing. We look at average days on the market. We're staying pretty consistent in that 138 in Charlotte County, and of course, up from a low of 39 days on the market. Median list price, this does reflect the low that we hit in November of 2020, and that was coming out of COVID. We then hit a high in May of 2022, and currently we're sitting at that 425,000 median list price. Again, when we break this down into the segments, you start to see that the low end of the market, that 279 and below price point, you still see some pretty good increases in median list price. As you get into those middle 2 tiers, you start to see it lagging a little bit. And then that upper end market, consistent, not really going up, not really going down, just staying pretty flat. I added this one in this month. This is properties with price decreases, and it shows the 4 tiers together. The bottom tier is sitting almost 60%. 6 out of 10 properties have taken a price reduction. The second tier in Charlotte, 52%, 50% in the upper 90, in the third tier, and then the top tier is at 45%. So you can tell that lower end home seller is being a little bit more aggressive, and it may just be that the upper end seller has a little more speculation time to work with. We come up to Sarasota County. We're currently sitting at 547,000 for a median list price. The median price of a new listing is 550. Average days on the market is 118 with a median of 77. And we currently have 4,482 homes for sale that are single family residential resales in Sarasota County. We're at 30. This is a indicator that we are right on the edge of being in a buyer's market. So it's pretty balanced. And yet I'm going to show you some data that'll kind of break that down a little further for you in a moment. When we look at the condo market, we are in a buyer's market for condos in Sarasota County. The median list price $399. We've seen the average days on the market 114 with a median days on the market of 70, and 52%. So 1 out of 2 have taken a price reduction, and about 2% have re-hit the market with about 2,500 total condos for sale in Sarasota County. When we break this down into the inventory, we're sitting at about 4,400 current available homes for sale, up from the low of 328. And those 3-digit numbers just still amaze me. Average days on the market sitting at 117, up from the low in May of 2022 of 37. I think that these charts, particularly this one, really gives your sellers more, or gives you more ammo to sit down and explain if we miss the mark, if we price it right, it may still take 3 months to sell. If we miss the mark, it's going to take a lot longer than that. Median list price for, I'm sorry, 587, down from the low in March of 2022 of right at 700,000. We have I broke this down again by the 4 tiers, and you can see a very similar trend, although the bottom tier in Sarasota County is pretty leveling off, and you can see it's kind of tapering off. So we're not seeing a lot of price increases in terms of the median list price. So we're flat. I would call this a flat market. Now, interestingly, the upper end of the market is still increasing. So a little different than what we saw in Charlotte County. When we go down to price decreases, this stands out. At the low, we were at 13.23%. That was savagely unhealthy, but currently our 7-day average is 58%. So price reductions are happening. It's very prolific. And again, when you see the impact of having to take a price reduction in this market, it really stands out, and I'll show that to you in a moment. Properties with price decreases by tier, they track pretty similarly, 55 to 40%. That upper tier still has less price reductions, but through the other 3 tiers, you're pretty consistent. We hop over to Manatee County. Manatee County is still a little bit on fire. We're still in the seller's advantage, and a lot of that probably is to do, well, now this wouldn't take the new construction into account, so this is just resale. So these are truly just resale properties. 595 median list price. We're sitting at 104 average days on the market, with 70 days being the median. 57% price decreases. So again, we're running very high, and about 2,973 homes for sale. The condo market in Manatee County, a little different. We are in buyer advantage, and I see Lindsay shaking her head. We're in buyer advantage in Manatee. Median list price is very flat at 320. You've got 54% have taken a price decrease. The average days on the market's 120, with the median 77. So that's higher than the other counties when you combine, when you look at both of those numbers. Currently 1,570 resale properties for sale in Manatee County. This is a look at inventory trends. Inventory continues to grow. Average days on the market. We are still up there, although you have tapered off a little bit coming through season here locally. So we're sitting at 103 days on the market. Again, up from that low of 32. Median list price trends, you can see we hit a high in April of 22 of 857,000. We're at 595. I'm not doing the math. I don't have the math, but I think that's about a 30%, 25-30% decrease in the median price. So that's a significant change. Price decreases, however, you can see they are still going up, and this is a sign that it's a highly competitive market and an indicator that sellers are having to get aggressive to attract buyers, especially in a high interest rate environment. When we break this down into the 4 tiers, kind of a similar trend as the other 2 counties. You got mid 50 percentile taking a price reduction, and then 44% in the upper end. So an indicator that those lower price properties they're being a little more aggressive in terms of the pricing to get things moved. Now I'm going to look through some analysis and I just lumped this together with Tri-County, since we've got market centers that service all 3 of these areas. I kind of put these in together and track what's happening here. Okay, this was one of the numbers that when I looked at this month really stands out, and this is one that I would put into your listing presentation. This is from Broker Metrics, and this tracks the average sales price to list price of a property with no price reductions. A seller lists their home, lists it at the right price, listens to their agent, follows their guidance, and they get an offer. Versus the seller that says, I want to try it higher, we could always come down. In March of this year, the average sales price to list price of the home that took no price reduction was 95%. So there was about 5% negotiating room. Interestingly enough, those listings that had to take one or more price reductions sold for 94.8. So 0.2% less, but very similar. But on average, there's 5% negotiation room in those prices. But the days on the market went from 24 days to 120 days. So when the seller says, hey, we can always come down, you go, we can. And it's taking about 3 more months to get you the same price or less than if we just price it right. So the moral of the story in this is that if it's a well-priced, well-positioned listing that's staged, that looks good, smells good, and doesn't bark at you from the curb, if you price it right, it will sell. So the market is still good. It's just we have to watch that pricing. So I think that's a fascinating one. You can see the trend of how that has trended backwards. It's been pretty consistent. You price it right, under 30 days. Okay. This is an average days on the market for under contract. So for pending properties, and there's a lot happening on this graph, but what I really want to bring you down to is just the bottom and show you that, just move this out of the way for a moment. If we look at March of 2024 versus March of 2025, on average, it's taking about anywhere from 10 to 13 more days to sell, which is about a 14 to 17% increase. So that would be important to note. I got a question here. Toy asked, when is the hose going to unkink? And I'm going to be honest with you, it's probably going to be when we see interest rates sit at 6.25 or less for probably 6 to 8 weeks, and that's when you're going to start to see people come off the sidelines. Lindsay asked, is that sales price the price it was offered at the time it went pending, or the sales price when it was originally listed? Lindsay, are you talking about this slide right here? Yeah. So this is they took no price reductions and they got an offer versus they reduced, and then whatever that reduction was compared to what it sold for is the sales price to list price. So it's the same metric, it's just the after reduced price. So if the average price reduction was, let's say, 5%, that means they actually sold for 10% less than the original price. Great question. This also shows some market dynamics, some month supply of inventory trends. For the green line is month supply of inventory of sold. And I'll break this down for you a little bit of a different format in just a moment. This is going to be month supply of inventory under contract versus sold. So how many months of inventory is currently sitting in the market? This is increasing. And it's obvious we have more listings out there with the same or fewer transaction counts. And so month supply of inventory is just up substantially over the whole period. Although versus last year, we're still in some positive territory. And when I break the data down this way, you get to see it a little bit better. Even though our inventory has grown, and even though it is the market dynamics are not the list it and get 30 offers like it was a couple years ago. When we look at the 3-county data in March of 25, our month supply of inventory is 6.1. 6 is considered to be a balanced market. Anything above 6 is a buyer's market. Anything below 6 is a seller's market. Currently in the US, the National Association of Realtors number is 7 nationally. So we're actually sitting better even with the amount of inventory that we have than what nationally is happening. And I think that's an important statistic. So it's not all doom and gloom. And you can kind of see those trends over the last couple months, and we've kind of been in a similar format, although 6.1, that's probably a reflection that our season here was very active relative to the activity in the rest of the US, because typically you'll see resale housing peak in June going into July in the US. Again, supply and demand, number of units, and this just gives you a visual representation of what's happened in the supply curve across all 3 counties. And you'll see here that March 2025 versus 24, the available properties for sales up 23%. The under contracts are up 2%, but the closings are down 2.3%. And that's probably an indication that last those high interest rates that we experienced in third and fourth quarter that depressed some of the sales. Okay. So let's kind of land the plane and talk about what does this all mean to you? So if we look at the median price trends year over year, and we're looking back to March of 2024 versus March of 2025, we break this down. Home sellers are becoming more realistic with their pricing as demand becomes more price sensitive. And of course, the interest rate changes, the competitiveness in the marketplace, the fact that we've moved into a buyer's territory. It's actually a good time to be a buyer, especially as rates start to come down. I noted in here the sharp decline in under contract prices suggests that buyers are negotiating harder upfront, or that they're completely avoiding overpriced homes entirely. The drop in sales prices, sold transaction prices, confirms that sellers are either reducing asking prices or accepting offers that are further below list price, which we know to be the case, but the data is pretty consistently supporting that. If we look over the whole territory, the sold to list price, and Lindsay, this kind of gets back to a little bit of your question, the average list to sale price has dropped from 96.6% to 95%. So there's more negotiation happening. The sold to original price. So I actually had this in here. I forgot that I put this in here. So what it originally listed for compared to what it sold at dropped from 87.5 to 86.2. So this is where if you price it right, on average, it's selling in less than 30 days and for 5% of the original price. If you overprice it, it's taking about 120 days across the territory and it's selling for 86%, 15% less than the original price and 10% less than what the well-priced listings are selling at. So they are becoming market stale. The analysis on this is more listings are being and buyers are negotiating down further from the original list price. It's a signal that strategy matters more than ever. The longer a property stays overpriced, the greatest eventual discount. And again, we know this to be the case, and yet we have a lot of agents that started in an up market, and so those dynamics have changed. When I really looked across the market, I could see stale listings are piling up. We've got a lot of market worn listings that are out there that just don't compare. And the challenge with that is you become the pinball listing, and that's a conversation I always had with my sellers. Is you don't want to be the listing that a buyer comes and looks at and they bounce off us to go buy the better priced listing. We want to be the one that they buy, and so we have to stay competitive. The sold price to days on market has increased from 71 to 81 days across the entire county, and cumulative days have jumped from 78 to 91. So things are just taking a little bit longer. It's an opportunity to educate your sellers on pricing and staging strategies early in the life cycle, and make sure that if you've got a property and it's on the market for 7 to 10 days and you don't have a lot of activity, it might be time for a price reduction. Okay. We look at year over year, inventory overall rose 23, so about 25% overall increase. And the property sold versus the property available, or the absorption rate, has declined from 14.7 to 11.6. And that's just an indication that things are slowing down overall as inventory increases. Month supply of inventory went from 4.9, which would be strong buyer's market, to 6.1. So if someone had been looking to do something last year, Q2, Q3, this year, the dynamics are they're different. We are firmly moving out of a seller's market in the area. We're moving towards a buyer's market. And again, 6 months is where we look to see that balance. We're sitting at 6.1 across the market, but with the inventory and the high rates, I would expect to see that move probably closer up in that 6.5 to 7 months of inventory. Demand is cooling, supply is growing, and pricing will continue to soften unless something materially changes on the economic front. Rates drop, confidence surges, we get past the tariffs. That would be a really big one, to be candid. And so those trends tell us it's a good time to educate our sellers on market realism and the dangers of pricing above the market. it's funny that I'm saying this. It's a good time to be dusting off your buyer's agent skills. We want to be listing based because listings are the high leverage opportunity. And yet being able to understand special financing, being able to understand 2-1 buy downs or 1-1 buy downs, being able to understand the usage of an arm and how to educate the buyer on how to smartly use financing to take advantage of a rate that they can refinance out of in 1 to 3 years when rates are probably, unless things just go really, really wrong, we will see lower rates in the next 12 to 36 months. So it's a good time to dust off those buyer skills, dust off those negotiation skills, know your market and really understand the economics. Control your days on the market by being aggressive early as a seller. If it isn't selling in the first 14 days, a change is needed, not just more patience. And lastly, part of the reason we're doing this is use data to win your listings. I think it's win listings and win buyers. Your market knowledge leads to client confidence. They're hiring you to be able to guide them through what typically is one of their biggest purchases, and your professionalism and your understanding of how all of this affects them can frankly even take a brand new agent and position them to really be the local economist of choice for the client. So that's where we are for this month. I think some of the things just to watch over this next 30-day period is going to be the impact of tariffs. It's going to be the the brouhaha between Jerome Powell and Trump and just how that dust up comes into play. It's probably going to be, I didn't really talk about this a lot this month, but the impact of Doge cuts as it relates to the impact on unemployment, because most of our employment gains the last couple of years have been in government and in healthcare, government being the number one. So as that reduces that back, that could push unemployment up, and that would actually force Jerome Powell's hand to make a cut faster rather than slower, because that unemployment is where it's going to be. But I think the story is going to be the trade, the tariff tap dance, and just really what happens with that. So that's where we are. I encourage you guys to use this data. I will send out a copy of the slide, a copy of the recording in case there's something you want to go back and just kind of brush up on. But use this data in your listing appointments and your buyer appointments, and I trust that it will be helpful and that you guys can continue to service your clients. So if you have any questions, yeah, you guys are most welcome. I see some thank yous in the chat, so we appreciate it. And with that, we will get you guys back to your day, and thanks for your time today.
Oh, Brian?
Yeah, oh, hold on. Yep, go ahead.
Just real quick, and this is just for the Market Center, do you prefer that I don't send this to our Market Center if they have not joined, or is it okay if I send it?
No, please, you're just fine to send the recording and the link.
Okay.
Absolutely.
Perfect.
Absolutely, no problem at all.
Thank
Great
you.
question. All right, guys, have a great day. Thank you, everyone.